In 2014, a lifelong janitor and mechanic named Ronald Read passed away. When his will was read, his family and friends discovered a quiet, staggering fact. Read had amassed a personal fortune of $8 million. He didn't win the lottery, and he didn't inherit a dime. Most of us assume that to build that kind of wealth, you need a specific, expected pedigree. We picture an Ivy League diploma, a high-powered Wall Street career, and an innate ability to read complex financial models. Read had none of these. Our culture treats investing like a hard science. We are taught that wealth is strictly governed by mathematics, spreadsheets, and raw IQ, where the smartest person in the room automatically wins. Author Morgan Housel points out the flaw in that thinking. Investing is actually a soft skill. Your outcome is dictated far more by how you behave than by what you know. You don't need to outsmart the market to secure your financial future. You simply need to outsmart your own human nature. Author and psychologist Daniel Kahneman noted a curious evolutionary trait. Organisms that treat threats as more urgent than opportunities have a much higher chance to survive and reproduce. Because of this primal threat detection, financial pessimists always sound incredibly intelligent. If someone predicts a catastrophic market crash due to inflation or government debt, we lean in and listen closely. By contrast, an optimist pointing out steady positive trends sounds dangerously naive to our survival instincts. Look at this line graph tracking market growth over time. You can see a slow, multi-decade upward climb interrupted by a violent, immediate downward spike. Progress compounds slowly over decades. Setbacks and tragedies happen violently overnight. These extreme overnight setbacks are often what Nassim Taleb calls black swans, massive outlier events that carry huge impacts on financial markets and are entirely impossible to foresee until after they happen. No economic model could have accurately timed the societal collapse of the Great Depression, the devastation of World War II, or a modern global pandemic. The data simply did not exist beforehand. The soft skill of investing isn't trying to predict the next disaster. It is preparing yourself, mentally and financially, to build a portfolio resilient enough to survive the disasters you never saw coming. High returns in the stock market do not come for free. Investing is a transaction, and the price is paid in the emotional currency of volatility. Take early Netflix investors as the ultimate test case for this psychological toll. If you visualized a bright future for streaming 10 years ago and invested heavily, you would be incredibly wealthy today. But this area chart tracks exactly what that journey looked like in 2011. Netflix lost tons of customers, and the stock plummeted a staggering 80% from its peak in a matter of months. Look closely at this lowest trough. Imagine the emotional reality of sitting in that loss. What do you tell your spouse? How do you face your children, knowing you might have just wiped out their future? Even if you avoid single stocks and buy a broad, conservative S&P 500 index fund, you still have to pay the fee. Over a 40-year period, those passive investors had to endure about 13 combined years where their portfolio was down 20%, and multi-month stretches where it was down 50%. A highly specialized doctor earning $500,000 a year is in the top 1% of earners. He feels fantastic about his wealth, right up until he buys a vacation home and realizes his neighbor is a CEO pulling in $10 million a year. But even that CEO, in the top 0.01%, feels his salary is peanuts when he occasionally hangs out with his childhood friend, Michael Jordan, sitting on a personal fortune of roughly $2 billion. And Jordan occasionally attends parties with Jeff Bezos, a man who increased his net worth by $75 billion in a single year. No matter your income bracket, there is always a bigger fish. This envy engine is why people act in ways we might initially find crazy. The lowest income households in the US spend hundreds of dollars a year on lottery tickets, even when they lack emergency funds. To someone living paycheck to paycheck, buying a ticket is a rational way to purchase a fraction of a dream that wealthy people already live. Different socioeconomic lenses create entirely different financial logics. Leveraging your portfolio to match someone else's highlight reel is a trap. True financial freedom means defining exactly when enough is enough and refusing to risk what you actually need for things you don't. Let's look back at Ronald Read, the janitor who quietly built an $8 million fortune. He didn't build complex algorithms to outtrade hedge funds, rely on insider information, or attempt frantic market timing when news turned bleak. He simply ignored his evolutionary instinct for pessimism. He willingly paid the daily psychological fee of market volatility, and he refused to step onto the endless ladder of social envy. He saved consistently and let compounding do the work. Being good with money requires an entirely different definition of intelligence. A genius-level IQ is entirely useless if you panic and sell everything during a 20% market dip. The ultimate goal of investing is not to maximize your mathematical returns on a spreadsheet. It is to optimize your portfolio for maximum psychological endurance, giving time the space it needs to do the heavy lifting.